The S&P 500 is on the verge of a correction, and the Nasdaq has already entered one. While inexperienced investors may stay away from the markets while everything appears to be going down, the smart investor knows this is one of the best buying opportunities out there. You don't want to buy at the top, you want to buy when companies are at the bottom. And this most recent downturn has fantastic companies trading at some appetizing valuations. Let's lick those lips and let's get through these gems. Let's start off by rolling some dice with Vici Properties. Much like the entire real estate sector, this has been hit really hard, but Vici now trades at a starting yield of 6%. Vici owns a ton of properties in the Las Vegas Strip. We're talking about gaming facilities, restaurants, bars, clubs, millions of square footage used for conventions and business meetings and golf courses. These are things that are not going to be disappearing anytime soon, especially not during a recession. We're getting rewarded whenever Vici's tenants pay their monthly rent, which by the way is under long-term lease agreements via contractual agreements. Vici, by law, as a real estate investment trust, has to return 90% of its taxable income to us investors as dividends. Hence why it's totally normal for them to have such a high yield. Analysts even think Vici is undervalued right now, with 7 buy ratings and a consensus price target 30% higher than today's prices. Once interest rates come down, that's going to cause another boom in the real estate market. And by then, it might already be too late to buy in. But one sector that's been hit super hard in 2023 has been healthcare, which is down 4.3% for the year. We know depending on the year, certain sectors perform better or worse than others. That's the beauty of being diversified, but healthcare has really struggled. Just remember, healthcare is seen as a defensive play, so whenever interest rates rise, Wall Street moves money out of stocks and into safer, higher-yielding assets like treasuries or savings accounts. That's naturally going to hurt healthcare stocks, but when money is so much more expensive to borrow, that's going to be less research and development and innovation going on in this sector, but there's going to be a boom in this industry soon enough, as healthcare is always evolving. Just this year, we had new products that remove large blood clots from the body and reduce the chance of stroke. So rather than picking an individual stock here, I'm just going to keep buying the Vanguard Healthcare ETF, VHT, which tracks the benchmark of the healthcare sector that owns 412 different companies in different healthcare sectors like biotechnology, healthcare equipment, facilities, supplies, pharmaceuticals, and so many other sectors. There's so many different ways to make money with healthcare. Their biggest positions are United Health Group, Eli Lilly, Johnson & Johnson, Abbott, Merck, Thermo Fisher, Pfizer. And if you wanted an individual stock that's been hit really hard, check out Johnson & Johnson, a dividend king that's hitting its 52-week low, now has a starting yield of 3.3%. Both J&J and VHT over long periods of time consistently have rewarded shareholders and are giving increasing dividend payments over time. It really is a set it and forget it type of investment. We don't want to constantly be worrying about our investments. Well, worry no more with these next 2 utility companies, starting with Duke Energy. Duke Energy is based out of Charlotte, North Carolina, and serves the electric and gas needs of nearly 10 million customers, mostly on the East Coast and Midwest. They have been in business for over 150 years and are a Fortune 150 company. One of the many benefits about utilities is that they are often regulated in conjunction with local governments, so there's often very little competition. And price changes are regulated, and people just generally tend to pay their electric bill. Duke currently has a blistering starting yield of just under 5%. Duke's dividend raises may not be the highest, but at least they continuously keep paying dividends. Just like Southern Company, which has a starting yield of 4.21%, Southern provides electricity and gas to millions of people. They have a very impressive streak of 22 consecutive dividend increases since 2002. You can tell they really value rewarding their shareholders. Overall, they have paid some sort of dividend for at least 76 years. As long-term customers continue to pay their monthly bills, that's going to fund that quarterly dividend, and Southern can even continue to expand its businesses, as they're currently building the first 2 nuclear power generating units in the United States in decades. It's that clean nuclear energy. Analysts have a $73 price target, which is nearly 10% higher than today's prices. So we get safe dividends and a chance at capital appreciation. What's there not to love about this? I also wanted to point out one more dividend paying stock, which I absolutely love, even though they don't pay the biggest dividend in Visa. Visa just announced earnings and they raised their dividend 16% and approved a $25 billion share buyback program. For my younger investors out there, companies doing amazing work like this, it's going to pay off so much in the long run if they continuously do great things like this. Imagine getting a 15 to 20% pay raise every single year. The compounding gets so incredible. Really, you just get to see how fat those dividends get over the years, plus all the capital appreciation that you don't need to pay taxes on as long as you just long-term buy and hold. That's going to be shielding you from taxes. That's the secret to wealth right there. Every week, I'm posting exactly what trades I make in my 6-figure portfolio. Check it out on Patreon, where you also get access to my entire portfolio. Let me know what stocks you're buying in the comments below. Hit that like button and check out more videos where I earn dividends every single month right here.